Hey everybody, welcome back to the Whiteboard Finance Show. Now on the main channel, Whiteboard Finance, we have our first guest on the main channel. I did take a break for about a year or so from podcasting. Full disclosure, I went to South Beach for the Bitcoin conference, got really lazy, and didn't upload any of the other episodes that I recorded. So I'm going to bring it back here. Our guest today is Nick Maggiulli. I hope I'm pronouncing that correctly.
Yes.
Okay, perfect. He is the Chief Operating Officer of Ritholtz Wealth Management. He's the founder of financial blog of dollarsanddata.com, author of Just Keep Buying, which he sent me a copy right here, as you can see. We're going to talk about that later. He's also been featured in the Wall Street Journal, CNBC, Money, and LA Times. And based off what I've gathered off your Instagram, you are a New York City foodie / steak, specifically ribeye connoisseur. Is that correct?
Yes, there's some dry age ribeyes will slip in there sometimes. But yeah, I didn't realize there's a foodie. Kind of realized this kind of more recently, but it's funny. Yeah. So it's great to have. I've loved being on the show. Appreciate it. Main channel. I'm excited for this. So.
Perfect. And real quick, for those of you that don't know him, that's actually how I know Nick is through Twitter primarily, where he has 115,000 subscribers. And his blog is great. I actually did one of my videos called Climbing the Wealth Ladder, which is your article, which I gave you credit for in the video. Just because I thought it was a pretty good metric of where people are at with their wealth building journey. And then we're also going to talk about, building wealth with Just Keep Buying, your book as well. So I know you're based in New York City. Where are you from originally? Are you from New York City?
No, I'm originally from Southern California. So grew up there, families, all my family, mom's side, dad's side, everyone, cousins, no one ever left. So they're all still there. So it's obviously very different. People are like, oh, I couldn't even tell you're from California. Like, I'm not like surfing. I'm not like, yo, what's up, bro? Nothing like that. So it's not really my vibe. It's funny because I feel like I fit better in New York City. I've always been like a, type A personality, very high energy, don't drink coffee, like just really go type person. So it really fits me that I kind of made it out here.
Yeah, I never would have guessed that. I thought you were like the stereotypical, East Coast Boston, New York City kind of a guy. But that's pretty interesting. Okay, cool. So how did you get into finance? I know that's not originally your background from what I read on the website.
Mm-hmm. Yeah, so I really liked, learning about economics in college and financial economics. I took a course. I was like, wow, this is great. And I just kept reading on stuff. I remember reading like Intelligent Investor, reading a lot of books on this stuff. But I went into consulting right after school. And I always knew like I love personal finance, I love investing and all that stuff. But I just couldn't see how I could work in that industry. I didn't want to be a stock picker. I took CFA level 1 pass. And I was like, wait, why am I doing this? Like, this is not for me. All this, like, I don't believe a lot of this stuff, And so I was like, I don't see how I'm going to fit into the industry. I can't imagine myself doing anything in the industry. Right. But then I started writing, when I was 27, I said, I'm going to change this. It was a New Year's resolution. So going into 2017. So Jan 1, I was like, I'm going to start writing once a week. And so I started writing, blogging on this stuff, just some ideas I had with data and trying to kind of give a different take on it. Mm-hmm. And I just applied like my data skills to that and just kept writing and, things kind of worked out. I got a job in the industry because I was like, hey, I'm really good with data. And I spoke to this wealth management firm where I'm at now, Ritholtz Wealth Management. And I was basically just like, hey, like, I know this isn't normal. Like, how often does a wealth management firm hire a data scientist? Basically never. So I said, I think I can help you guys. And they were very technology forward. So I was able to it was a perfect fit. I started doing stuff there as a data scientist, and then that role kind of expanded. And now I'm the COO there now. So it's been very fun journey, but that's kind of the long story short of it.
Yeah, very cool. Well, I know Ritholtz, they have a large presence on social media. A lot of the guys that work there, is that correct?
Yep. Yeah. Everyone like Josh, Barry, Michael, Ben, all of them. Yeah. They're Twitter, YouTube, they have podcasts, right? There's a lot of stuff there. So it's funny, like, I, as successful as I am, whatever, I'm still like the 5th most popular blogger at my firm, right? It's like very funny because that's what they do. They're very good at it. And they do it a lot. Like I only write once a week. They're doing, a couple posts a week. They're doing multiple podcasts, all this. It's like they're doing content in a way that I just I can't do that. I just write my one post. So,
yeah. Well, your stuff is very good quality though. I mean, I would definitely say it's quality over quantity. I'm a big fan of the blog. So in terms of like data science, I mean, that's pretty interesting because a lot of the viewers, they probably don't realize that, a lot of, stock picking, if you will, if you're on the buy side, not necessarily the sell side for information, but a lot of people are getting more into data and algorithms and computer programming rather than your traditional, hey, I'm going to pick up a copy of The Intelligent Investor, and read like a ticker tape, right, and try and invest the stocks that way. How prevalent is that now in the industry? I know not necessarily from like a wealth management side of things, but just from a quote unquote stock picking side of things?
So I don't know as much on the stock picking particularly, but I do know like there's like quant funds that do this, like quantitative using factors. That's been around for a while in the literature, at least, I know like beta's been around for a while. I know in the early 90s, like momentum, Cliff Asness, there's a lot of popular people in the space that have been writing about this for a couple of decades now, and they're applying it. Like firms like Alpha Architect are doing stuff like this. They're always writing papers on this. There's a lot of quant funds that do this type of stuff where they're talking momentum, quality, value, you name factors. There's something called the factor circus or the factor zoo. I can't remember who came up with this idea. I can't remember now, but they're like, we've tested every factor out there. And there's a lot of people think most of them are just BS and not real, but it's super interesting. So yeah, there's a lot of people doing that. And I think as data comes out, there's gonna be more people trying to find ways to get edge, whatever that means, so
very cool.
I think it's interesting.
Yeah. I think just by reading your blog, our investment philosophies are probably very similar. I've never talked to you about yours personally, but just for the audience, Nick and I have, we've talked through DM and, through Instagram and Twitter and stuff like that. But I haven't really got to sit down and pick his brain about his investment style. So what would you say your personal investment philosophy is like?
Well, yeah, I define it in Just Keep Buying. It's the continual purchase of a diverse set of income producing assets. That is my investment philosophy. And so it's not very defined. You're saying, well, what's an income producing asset? What does that mean exactly? Because there's a lot of ways to get rich. And I'm not here to say you have to buy stock ETFs, you have to buy bond ETFs, you have to buy REITs. I'm not saying that, because there's some people like real estate, and you can get rich doing that. You can get rich a lot of different ways. And so I've realized that by studying this, and there's a lot of people like, oh no, this is the only way to get rich. And I'm just like, that's not true, right? There's a lot of ways to do it. And I think the truth is you just got to own income producing assets, as that's bulk of your portfolio. I know you can own some non-income producing assets as well, and we can get into that, but that's my investment philosophy generally. Now, what do? I do stuff that's just really easy. Like I own REITs, stock ETFs, index funds, things like that, because they're just easy to own. I don't want to deal with tenants and things like that, but you can earn higher returns doing stuff like that. You have leverage, you have physical property you control. There's a lot of things you can do with, something like physical real estate that you can't do with a REIT. So there are definitely trade-offs with that. And for me, I'm just like, I just want to like invest my money and then forget about it and focus my energy on other stuff, creating content, trying to help people, versus like spending active time to manage my money, so that's kind of my thinking on it. But yeah, I don't think there's like a wrong. I'm very, very hesitant to say like there's a wrong way to invest. There are certain things like high risk, so that's like leverage, all sorts of risk way, like any high risk thing, market timing stuff, like picking, just like putting all your money in like a handful of stocks, usually a little risky. So all of it comes back to risk at some point. But yeah, outside of that, I'm generally pretty open to different ways to build wealth, as long as like income producing assets are the base of it.
Yeah. My pinned tweet is literally talking about like, hey, saving $3 in a cup of coffee is not going to build wealth, and it's not going to move the needle. You need to just, diversify into income producing assets, period. That's really all it boils down to. So I think our philosophies are very similar in that regard. So you have a very popular blog post called Even God Couldn't Beat Dollar Cost Averaging. So there's a lot of people on different sides of the dollar cost average versus lump sum camp. I know Vanguard came out with a study maybe like 10, 12 years ago. There's been multiple studies on this. If you want to break down that article and like your own philosophy on dollar cost averaging versus lump sum.
Okay, so there's a couple of things we have to unpack before we get into that. So when you say dollar cost, when I said dollar cost, even God couldn't be dollar cost averaging. The problem is there's technically two definitions for dollar cost averaging.
Okay.
There's like, hey, you're buying every 2 weeks in your 401k or with your paycheck. That's called dollar cost averaging. You're just buying over time. Then there's dollar cost averaging, where let's say you sold a business or you got an inheritance and now you have like $100,000, right? And you want to invest that in the market. Like instead of putting it all in right away, you slowly add it into the market. That's also referred to as dollar cost averaging. In the book, I don't call that dollar cost averaging. In the book, I call that averaging in, because you take a bunch of money, you average in. I'm trying to make sure I use the right terms here, because when you say dollar cost averaging, you just refer to both of them differently. Like lump sum versus dollar cost averaging, that is, in my opinion, lump sum versus average in, because lump sum is like saying, hey, I want to invest the money as soon as I have it. And that the definition you gave for dollar cost averaging there is like, oh, I take my money and I slowly put it into the market. I'm mostly in cash and I slowly kind of get invested. So those are kind of different things. So I just want to preface that as like, lump sum versus average in. Lump sum is clearly better most of the time. Why? Because markets generally go up. So you're talking, 70, 80% of the time, you're going to beat that. Like you can do this in almost any asset. I literally have tables in the book where I show by asset class, like, here's exactly what you might experience. Obviously, it's based on historical data, but generally it's better to get invested as soon as possible. So the dollar cost averaging I refer to, like just keep buying, is like when you're buying over time, right? You just, as soon as you get your money in your 401k, you invest it. So you can think of that as like a very small lump sum investment, right? You get a little bit, whatever. You take your 4%, 6% out of your paycheck and you put it in right away. So you're putting in right now. It's a small lump sum. You're not taking that 4% and saying, okay, I'm going to allocate that over the next 6 paychecks. No, you put it in right as you get your paid, right? So that's the thing. And the main philosophy is like, buy as quickly as you can, like, or as soon as you can, not as quickly, as soon as you can. Because generally markets go up, and because that happens for most income producing assets over time, there's always exceptions. You can be like, what about Japan? What about Greece? What about Russia? Like, I can find you plenty of exceptions, but there's far more in the camp of they generally go up over time than the camp of, oh, they go down over time. Right. So, and if you think they're going to go down, why are you investing anyways? That's the whole point of investing. Of course. To like turn capital over, hopefully it grows into more capital. Right. So it's the premise. The premise is built. Like, you have to agree with me by definition, or otherwise, why are you putting your money in? Right. Yeah. That's the kind of the problem.
That's a very good point. So, sometimes when I take these consulting calls one-on-one, and I always talk. I don't want to say talk both sides of my mouth, but I always like to play devil's advocate, because I do bring up like Japan as an example. So, for example. For those of you that aren't familiar, the Nikkei basically stayed flat from like early 90s to literally like last year or 2 years ago. So if you invested $1 in 1990 in Japan, I'm just using, I don't have the exact years in front of me, but just assume early 90s to late 2020s. If you put in $1 in Japan in the 90s, you'd get $1 back, literally 30 years later. So for those people that are like these kind of like doomers and gold bugs and, the precious metals guys at 2 a.m. trying to sell you, gold and silver and all that, where it does have a place in the portfolio. I personally own gold and silver as well, but I'm not like, precious metals guy, if you will. What do you say to people that bring up examples like that, or like the Greek debt crisis, or Cyprus bail-ins, things like that?
I mean, they're the exceptions to the rule. And that's, so even with like Japan, with like 89 was the peak, right? Or 89, early 90s, doesn't really matter. There was still very high. No one invests like that though. Who goes and invests all their money in one market one time? Like, if you sold a business in Japan and you're a Japanese investor, let's say in 1989, and you had 1 million yen or something, whatever, some large amount of money. I don't know if that's a large amount of money, but 1 million yen, you invested all of it right there. Then yes, you are one of the exceptions that got screwed badly, but probably didn't. Most people were probably buying over time. And so yes, the market crash, that's not great. But I do an example in the book where I say, let's say you invested $1 a day into the Japanese stock market starting in 1980, you go up into 89, then it crashes. Even then, like by the end of the period that I show, like you're up on your money. You're not up a lot. It's not great. I'm not going to lie to you and be like, oh, you would have built a lot of wealth. You wouldn't have, but you basically would have kept pace with inflation, right? Just barely, right? So I think that's the kind of thing you have to think about. And so the exceptions exist. Like, I know them all, right? I can be like, the worst one I think was like Spain 73 to 83. That like declined a lot. It started to have a rally and then it declined even more over 10 years. You can imagine your money just going down over and over and over. It's terrible. So right, that Greece 08, what's going on with Russia right now? Went down 80% in, early 2022 in like a month. So like, there's plenty of these examples where they occur, but there are far more examples where this didn't occur. The record of history is clear. Like most equity markets, if you're a diversified investor, you're buying over time, it's very unlikely you're going to lose money. And I think in international stocks, for example, if you do this for 10 years, just buying every month for 10 years, the chance that you would have underperformed inflation is only 15%. 85% of the time you would have beat inflation, right? Like you would have just done, and in the US, it's 98% because the US has just been pretty exceptional in its own right. And if you diversified across more markets, it's even lower. So that's the kind of idea, is like, if you're a diversified investor, this is not really a problem generally.
Yeah, I'm glad you brought up diversification. Some people diversify. I do. I know that I look at my net worth like a pie, and each slice is just a different asset class, whether it's real estate, it could be, crypto, collectible cars, whatever. I just look at everything as a pie. And I dedicate a certain weight or a certain percentage to each one of those asset classes. And that's my sleep well at night portfolio. So if say, for example, 15% of my net worth is in Bitcoin goes to zero, I'm not drinking myself to death or jumping off a building, right? I'm able to withstand that because that's what I allocated for. Some people say diversification is key, which I personally do. Other people call it diversification. What are your thoughts on that?
No, I think so. The phrase is, okay, concentration to get rich, diversification to stay rich. Well, the question is, how rich do you want to be? If you're trying to, I don't know what your income or people's incomes are, but if you're trying to get to $100 million, you're not going to do that by buying the S&P 500 unless you just have like an insane
A ton
income.
of
It's
money.
just not going to happen,
Yeah,
right?
yeah.
Unless you're like a law firm partner and you're getting paid 10 million bucks a year, like you could probably get there, but that's not going to happen. So I'll admit, you're not going to get super rich, like super, super rich doing this strategy. But for most people, for what most people care about in life, you don't need that much concentration to like get sufficiently wealthy. And so I completely agree with diversification. And it's like, well, why would you're doing that because you have no faith or conviction or this and that. People say that, like, no, I have more conviction. I have more conviction that my diversification strategy is going to get me to my goals than me trying to pick individual stocks or me putting all my money into one asset, because things happen. Imagine you're like, oh, I have so much faith in the Russian market's undervalued. Imagine end of 2021, you're like, look, at the Russian market's undervalued. The P over E is way less than the US. You put all this money in there, you're convinced, and then you just got wrecked. You just got absolutely wrecked. This happens all the time. It's because you had too much concentration. I've seen it happen over and over again. And so people say that passive investors have no conviction. It's like, no, I've looked at the data. I've looked at it every possible way. I have more conviction that I'm going to beat most investors over the long run just by doing that and diversifying. And that's the key. It's not about being the best. It's about beating most people, only because I'm not making foolish decisions.
Yeah, I completely agree. I think my school of thought is, are you familiar with Bogle heads?
Yes,
Jack Bogle.
Of course.
Yeah, so the people that aren't familiar with Jack Bogle, founder of Vanguard, the Bogle heads basically have a 3-fund portfolio. It's essentially, U.S. domestic stocks, you have international stocks, and you have a percentage of bonds depending on how old you are. You can do 80-20, 50-50, whatever. It just depends on your risk tolerance or appetite. But I would say that as you mentioned, for 90% of people out there, they just want to live their lives. They're not professional stock pickers. They're not, data analysts. They're not quants. They're not sitting here reading, 10Ks, burning the midnight oil. They want to go play with their kids and, go to a basketball game or something. So I think that that strategy for most people is the best strategy most of the time. Would you agree with that?
Yeah. And here's the funny part. I am a quant. I am someone who understands data, like to some degree. Right. And I'm just like, I still do that same strategy. Like, that's the point. Like, I've studied the data and it's not worth my time to go spend all this extra time to maybe possibly earn alpha. And I could get negative alpha. I could lose money by doing this. Like, that's the point. It's like, I shouldn't be spending so much time on an endeavor that's not necessarily going to net me any money. My time is better spent, writing blog posts or doing something to help other people add value there than for me just trying to like increase my portfolio value, right? Because I don't know if I will. And then if I don't, it's even worse because I spent time losing money. It's stupid. It's the dumbest thing. So
yeah, absolutely.
Yeah, that's my take on it.
No, I hear you 100%. So just from my selfish standpoint, because I am a content creator, I was thinking about getting into blogging. I have my own blog, but I don't treat it very well. I haven't updated it in probably like a year and a half. I've just been so busy with YouTube. What's it been like running ofdollarsandData.com? Not just from like a business standpoint, but just from a fulfillment standpoint, and like how many doors has it opened up for you that you never would have imagined when you started in 2017?
Yeah, absolutely changed my life in so many ways. I can't, like, there's just little things like, I don't know. I wrote it for 3 years, didn't make a single dollar on it. And then I started running ads and I've had ads up. And so I make some money on it now. But even now, like, I've actually been reducing ads. I used to have in-content ads. And I was like, I was like, looking at I was like, this is so like distracting. I was like, I don't care. So my earnings are now cut. My earnings are half this year than what they were last year. Cause it's not worth the money anymore. I'd rather have more readers. I want more readers. I want more people to be like, wow, this guy's good. And I don't want to waste people's time. So I do have some ads. You're going to see little sidebars and things like that. I still want to make a little bit of money, but I'm like, I'm not trying to be greedy about this. And so for me, it's like, it changed my life in so many ways. Like even little things, for example, my grandfather, I wrote this post on smoking. My grandfather quit smoking after 62 years, right?
I remember
I wrote this post talking about this and, all those cigarettes he smoked and everything. Someone reached out to me and said, I've smoked for 30 years and I'm quitting today because of that. And like, there's just stuff like that. Or, I've written about my struggles with drinking alcohol, binge drinking. And, someone said, hey, like I sent this to a friend and he quit drinking, but they told me like, I wrote about it again. They only told me about it in the second article. So like this stuff's happening without me realizing it. And it's just like, for me, like, what's the value on that? What's the value on helping someone else? Like, it doesn't matter. Like, the money is irrelevant in that. So for me, it's almost like a sense of therapy, really. It's like, this is my way of like, just thinking about the problems I've had in my life. And I'd say it publicly. And yeah, it's a little scary to do that sometimes, but I don't really care if I'm in a, be judged for that, that's fine. But I'm still a human at the end of the day, despite all this, like, oh, I'm a quant, whatever. I'm still a person. I still go through the same stuff that like everyone else goes through.
Absolutely.
So, and I think we're missing some of that in society,
100%. I think, I put myself out there on YouTube, but I'm just a regular dude. Like, I'm from suburbs of Cleveland, Ohio. It's like, I'm not some like, movie star that had like crazy technical background on how to set up a studio or anything like that. I'm just a regular dude. But I think that it's good to put yourself out there because you kind of hold yourself accountable. And whether you talked about, cigarettes, your grandpa's cigarettes, or, drinking or whatever, I think it's important because it makes you more human. And I think people relate to that more. If you try to portray yourself as some, genius, which a lot of social media gurus do, that just creates false expectations, in my opinion. But what I wanted to talk about, I know that we're getting kind of like maybe 20, 25 minutes into this podcast, was your book, is Just Keep Buying. I know we touched on a lot of the things that are most likely in here. I did get your copy just this morning. I haven't visited my P.O. box in a while, so I haven't had a chance to read it. But I'm assuming we did touch on a lot of what it's about. Your little blurb here says, proven ways to save money and build your wealth. So my mantra on this channel is, hey, everybody, welcome back to Whiteboard Finance. My name is Marco. I'm here to help you master your money and build your wealth. So what would you say the difference is between, getting rich, TikTok celebrity, Ferraris, Lamborghinis versus building wealth? What is your difference in that definition?
I mean, they can be the same. They don't have to be, though. I think a lot of people who build wealth, you don't necessarily need to be flashy with that. I think, and it really depends how you define wealth. I think some people would say true wealth is like freedom to do whatever you want with your time. I mean, some could say that's wealth, right? But because you have enough financial assets so you can do that, right? Those people you have all these Ferraris and this and that, like you have some wealth there, but at the same time, like you may have to keep working indefinitely to support that lifestyle. So it's really about kind of your definition of wealth. There's different types of wealth: social wealth, there's obviously financial wealth, there's, time wealth, there's all those sorts of things. So for me, I don't like putting a specific definition on it. I think building wealth is, it's about allowing you to live the life you want to live. And the hard part, I think, for most people is figuring out what you want. Like, what do you really want in a life? And that's like, I'm not a philosopher. I'm not gonna be able to tell you that. I'm still figuring out myself. And I think a lot of people are. And so the thing is, like, once you figure that out, it's going to do some soul searching. Then you can kind of solve for, well, how much money do I really need? Like, I'm not necessarily against owning flashy things, nice cars, things like that. I don't personally like nice cars, but I'm not against people that do, because I would consider an exorbitant amount of money on restaurants. That's just what I like. That's my area where I'm like, I'm going to spend extra because I like it.
That's right.
You're not going to see me driving a Ferrari. You're not going to see me flying first class, that, none of that stuff. So that's the kind of the idea. So, yeah, I mean, for now, that's kind of what I'm doing. So.
Yeah, I think that, are you familiar with Ramit Sethi? I Will Teach You to Be Rich.
Yep, of course. Yeah, we're good friends. Yeah, it's like, what's your rich life? That's kind of his whole thing.
Yeah, I saw him at FinCon in 2019. It's funny enough, I actually bought his book when it first came out when I was in college. This was probably, if I had to guess, 2009-ish, 2010-ish. I graduated in 2010, so it had to have been before that. But I like his idea of wealth dials. It's like, hey, say you like really nice shoes, well, save in other areas of your life and then spend on your wealth dials. Turn your wealth dial to the max on the things that you like. And I really agree with that, because I think there's a lot of bad financial advice out there online. I'm not talking about like the ridiculously bad stuff, like people on TikTok saying like, hey, just buy low and sell high. It's super easy, right? You're like, oh, no shit, But I'm talking about like, when you have Dave Ramsey saying, turn your fan on reverse and go, go open up your app and, put more air in your tires to save 5 cents a gallon on gas. Like, dude, are you kidding me? So I enjoy the idea of helping people build wealth. And I guess my definition of that is, my parents are immigrants, my wife's parents are immigrants, but in one generation, we were able to, live in a middle-class neighborhood in the suburbs, things like that. I was able to go to college, stuff like that. In terms of like generational wealth, this is something that maybe you can speak more to because you're in New York City. And I also worked in commercial real estate here in Cleveland. There's a lot of families that are worth a lot of money here, a lot of old money. What is your take on like generational wealth, being able to pass things down to your family?
So I have a mixed take on that. I understand why people do it, but at the same time, if you really think about, at least this is my personal experience, I can't speak for anyone else, but like a lot of the reason why I think I've been successful is I have this drive, and I wasn't, I obviously had a good family, like I never had to worry about going hungry or something. Didn't grow up in pure poverty, but like I also didn't have, so like I didn't have a car in high school, like just couldn't afford one, right? Like my parents couldn't afford one, you know, and I was like, why didn't you just get a job? Well, it's because I was studying all the time. I was trying to get in, you know, I got really good grades, was like top of my class. That was my job, right? And so I kind of gave that up, made a sacrifice there for that. But it's like, at the end of the day, like, you know, the things that made me great was that drive, and to think like, if I just had everything given to me, I may not have felt the same. Now, I'm not saying that that's what's going to happen with you or your kids or whatever. I think there's I don't know, I can't remember the exact Buffett quote where he says like, you give them enough where they can be anything, but not so much that they don't want to do anything. Or you kind of, right. There's an ideal level of giving where you can give them opportunity, but not so much that they just don't want to do anything. Right. So they have to do something to be around. And so I think that's my take on it. It's like, you know, there's a lot of people like, wow, I grew up with so little. And then they're like, oh my gosh, I want to give my kids everything. It's like, it seems like it's hypocritical. And to me, at least, it's like, wait, so you're talking about you pulled yourself up on your own bootstraps, you worked hard, you did all this stuff, you overcame all these obstacles, and now you're going to take away all those for your children. And that's going to somehow make them great. Like, it's funny. I see it all the time about all people talking about generational wealth. And I don't love the idea of it. I also think it's weird in some ways, but you know, we don't have to get into all that. Of course, I think like you should give people, you know, you want to give your kids a good life. I get that. At the same time, like it's almost, sometimes it's overdone, I think.
100%. My brother-in-law and I, we talk about this all the time. We talk about how in the middle class, you have too many options to where it's like, you know, you can almost be whatever you want to be, but life isn't hard enough to where, you know, you have Biggie Smalls saying like, you either got a wicked jump shot or you're selling crack rock, because those are your only options. You're either playing sports or, you know, dealing drugs. Or on to your point or example, you know, if you're like a trustafarian where you have a trust and you're just like every quarter you're getting $100,000 from your trust, you know, it's like you have no motivation to do anything else. So I think that if you're kind of like in that area that you grew up in, or maybe how I grew up, you know, it's like you have that almost like a chip on your shoulder to want to succeed. But I also think it's how you form the trust. So maybe like money is released when you're 35 or 40 or after you have 2 kids or whatever the definition of that money is. I think if you give too much too early, like when the kids are like 18, like, yeah, you can definitely mess them up that way. But I think a lot of it has to do with how you structure that stuff.
Yeah, of course. I'm not an expert on that by any means, but yeah, that's something where you got to talk to people who really know their stuff there.
Cool. So I feel like I haven't done your book enough justice. If you had to give like an elevator pitch on what this is about, not knowing what we talked about, you know, previously in this conversation, how would you describe Just Keep Buying?
I'd say it's a data-driven guide to personal finance and investing, but it's very accessible though. So it's not one of these like tons of spreadsheets, tons of data, you're going to get bored. I start with stories. I kind of give anecdotes. It's filled with a bunch of good research. So it's very accessible. And the thing why I think it's different, because I go back to first principles. I say, we have a lot of beliefs in personal finance. One of them is like, oh, we aren't saving enough. We're going to run out of money in retirement. We should max our 401ks, all these types of things. And I say, are those actually true? Like, let's look at the data. Let's look at different forms of data and see if that's true. And a lot of these things I found aren't exactly right, you know? And so, you know, for example, it's my second chapter is called Why You Probably Need to Save Less Than You Think. And I talk about like why you're probably not going to run out of money in retirement. So that's not true of everyone. But if you look at like, for example, there's just shocking statistics. Only 1 in 6 retirees are actually drawing down principal. Most of them live off their dividends and Social Security in the United States, right? So it's like 5 and 6 are doing that, you know? And the people that don't, you're like, well, I don't have any principal. It's like, well, then you're just living off your Social Security. Obviously you're surviving somehow, right? It's not great, but that's probably what's happening. So it's these things where like, maybe not everyone's living the perfect lifestyle they want in retirement, but like a lot of people aren't drawing down principal. And that says like, maybe, you know, and I know personally from like, you know, you have people who take RMDs, and what do? A lot of people get RMDs. They just reinvest the money. They don't know what to do. They pull it out like, I don't know what to spend. You know, you end up spending less in retirement.
Sorry to interrupt, Nick. For the people that don't know what an RMD is, I know what it is, but what would you, how do you describe that?
It's a required. So if you have a taxable account, like say 401k or IRA, you have to start taking distributions by a certain age. I think it's like 70 or something, 72. I can't remember the exact age, but you have to start taking money out. You're required to, because the government wants their money. Like you got to start paying your tax bill, right? So you got to start taking money out. I apologize. I should be defining things. You got to start taking money out over time. So basically a lot of people, they take money out and they're like, oh wait, we're already good with like our Social Security and like whatever dividends we're getting. So like we have to take money out and then we just reinvest it. So a lot of people end up reinvesting their RMDs, which is kind of funny. So it just shows like, I think there's a fear is greater than like the actual issues, right? And so everyone's like, there's a huge retirement crisis, all these things. And the data is not supporting, at least now. Maybe the next generation will be really different, but even if Social Security runs out, I've looked at the data on this, and like, they'll be able to pay, I think 70 to 80% of benefits through like, 2035 or something. So a really long time. I think it's going to run out, and then we'll be able to pay benefits for a very
I
long
think
time.
it runs out in
current
2030. I think it runs out in 2030 because I actually talked about this as well. I think that what they're going to keep doing, it's inevitable, is that they're just going to keep making it, till you get older and older. It went from, 60s or whatever the number was to 70s, and who knows, how much further they're going to push it back. I feel like that's the issue with a lot of pension plans. So my wife works for a government hospital here in Cleveland. They have OPERS, Ohio Pension, and a lot of these pensions are underfunded. They're not 100% funded. So I feel like the estimates that they're giving you, or the projections that they're giving you, they're not going to be able to meet that once that date comes. Like, what are your thoughts about that?
Yeah, I think they're just going to have to change retirement ages or cut benefits a little. I don't think it's going to go to zero. So it's going to be like tightening. It's not going to be like you're going to get zero Social Security. I think that's a ridiculous argument. Like, unless the United States fails, but in that case, it's not going to, your Social Security is not going to matter.
It's not going to matter.
Like, a lot of these things, like all these extreme cases, like, oh, what if there's a Great Depression? Like, you're not going to care about your investment portfolio, the economic impacts, whether you're getting food, guns, canned goods, all these. No, that's more important than a lot of these other things we talk about. But yeah, in those cases, like, I think they're going to have to do something with retirement age, or the age you get benefits, or just how much you get, or the inflation index. There's all sorts of things they can do, to different levers they can pull, but I don't think it's going to zero. And I think that's the thing to keep in mind. So a lot of people are, I think, really worried about, am I saving enough and stuff like that? And my point with thinking about the book is like, just, I'm analyzing data to show like not all these things you think are true are necessarily true. And that's the point.
Have you read Morgan Housel's Psychology of Money?
Of course. Yeah. I've read it.
Yeah.
Yes.
I listened to that last summer when it came out. I was cutting the grass, and over the course of 2 or 3 grass cuts, I finished the book. And it just hits the nail on the head, man. Just from when he talked about, the GI Bill, and talking about like World War II and all these things. What are your thoughts on not just the book, but just like world events going on right now? Obviously, at the time of this recording, there's stuff going on with Russia and Ukraine. If, God forbid, something like World War III were to happen, I'm not saying it's going to, but just say an international conflict of some sort, where markets typically, correct or crash, to be frank, like, what are your thoughts on books like Psychology of Money during events like this, if that makes sense?
I mean, yeah, psychology matters a lot for a lot of things. And so I think, what Morgan's really good at doing is saying like, hey, like, here's a story about something, and here's how it relates to how you can think about money. And so like during times right now with like geopolitical things going on, it's very easy to like, see all this and get worried and be scared. And it's a natural reaction. It's completely natural. But the course of history shows that these things generally sort themselves out. And here, as I just said, like the whole argument, it's one of these, when you're investing, you're really making this bet that like, oh, I hope like we don't have a Great Depression. And like, if you do, it doesn't really matter what your money is doing, right? That's what I'm saying. If you have one of these extreme events where there is a World War III, and like, God forbid, something really terrible happens, like, it's not going to matter anyway. So it's really like, it's not going to matter in the downside, and in the upside, let's say it doesn't happen, then you're great. You make money. The world's better, whatever. It's like, that's kind of how I look at this bet. And it's like, it's basically only upside, because in the downside case, it doesn't matter anyways. Like, you have more important things to worry about than like, oh my God, I'm not going to have enough dividend payments next year. Right. Like, yeah, that's not the thing. So
yeah, it's almost,
but I think Morgan's book's incredible. He's probably the best financial writer out there. And so he's just great. He's a great storyteller. And, the thing is, when I read the analogy I like to use when reading psychology, so I'm like probably one of Morgan's biggest fans. I've read everything he's like written, or tried to. I can find everything with Motley Fool going back, but like everything I think he's done with CloudFront, I've read it all. I know it all very well. And so a lot of Psychology of Money, like Just Keep Buying, is based off prior work. So you've seen some of his old stuff's in there, just like some of my old stuff's in that book.
Yep.
So when I was reading, I was like, wow, I remember this. It was so good then. And I'm just trying to think, like, imagine someone, like, because I was reading him for like 3 years and just getting like, he's so good, like getting all this, like over 3 years, I was like getting this slow flow of like just insane, like, this is amazing content. And imagine someone getting all of that, like in a book, like right away, like getting, like, never heard of Morgan. They read it, like, what the heck's going on?
It's like a shot of adrenaline.
The analogy I use is like reading Psychology of Money is probably like doing DMT, which is like this really intense drug. I've never done it, but I've just heard it's like crazy. You see all sorts of crazy stuff. But then like my experience of Morgan is more like ayahuasca. It's like a 6-hour slow DMT trip that took me 3 years, basically. So I've never done either of those. I'm not recommending any of that type of stuff. I'm just saying, like, that's the analogy, the best analogy I can think of in terms of having my mind blown. But it was really cool either way. So yeah, big fan of the book.
Yeah, absolutely. I think he does a great way. He has a great way of giving real life examples and kind of relating them to today, which I really like because, I always need a refresher every now and then because I will play devil's advocate here. When I listen to people like Michael Saylor, right, CEO of MicroStrategy, big Bitcoiner, and we'll talk about you selling Bitcoin a little bit here later. But when I hear Michael Saylor talking about all the things that I've personally been studying, I'm a big fan of history, geopolitics, finance, things like that. When you see the devaluation of fiat currencies, and when you see investors just going anywhere and investing in anything just for some sort of return, when you have like poop coins and butt floss coin and TikTok investors and all the stuff that just incredibly terrible advice in my opinion. I'm gonna challenge you a little bit here. How do you feel when you see a guy like Michael Saylor talk, when he talks about, most fiat currencies, they go to zero over time, not literally zero, but they lose 90% plus of their value over time or purchasing power over time. What do you think about stuff like that when you hear that?
I mean, it's not wrong. I don't think there's an issue. I don't have an issue with that. That's a fact. I mean, whether the question whether Bitcoin's the solution to that is a separate discussion. I think he can be stating a fact, and then but his opinion is okay. Bitcoin's the solution, and it may be, it may not be. I don't really know.
Bitcoin,
honestly.
yeah, Bitcoin aside, just the fact that we are living in an inflationary, monetary system, things like that with technology, which is deflationary. I don't know if you know Jeff Booth or The Price of Tomorrow. That's a really good book. You should check it out. I've had him on the podcast, but I guess just Bitcoin aside, what are your thoughts on just what we've seen over the past 2 years? M2 money supply hockey stick. M1 money supply, hockey stick, Fed balance sheet, hockey stick. What are your thoughts on stuff like that?
I mean, I'm not too worried about that stuff. I understand, like, yes, and inflation happens, and it's kind of like general inflation is like the agreement we've made as society, so that you can't just put your wealth under your mattress and every year like it's still the same. Like, no, you're going to lose money over time. Now, most people don't realize that, right? And that's just why they need to get invested. So, but that's like an agreement. That it's an implicit, I mean, I don't know if implicit is the right word, but it's an agreement we made as a society. We agreed like, okay, if you have capital that can be used, you need to deploy it and use it. And if you don't, you're going to be punished for that, right? We don't like hoarding. So that's really the case there. And so people are just, if you had $1 million and you just sit in cash, like you should be punished for sitting in cash and not providing it to somebody that can actually do something with it, right? You can imagine it's like someone who has, imagine it like let's go back to like a medieval sense. Imagine you're someone that has a plot of land and, people are hungry and you're like, you know what? I don't want to give any, I don't want to actually grow anything on this land. Like you should be punished for that. Like not physically or anything. I mean, just like, that's like, you should be contributing to society in some way. I think that's the reason they're inflationary is because we've essentially said like these things are going to be devalued because you need to do something to grow them. Otherwise, you're losing.
Yeah, it's kind of like, it reminds me of Scrooge McDuck, jumping in his vault of gold off the diving board.
Yes, exactly.
So I'm not sure how familiar you are with my channel, but I have a series of videos called Savers or Losers. And the big misconception that people don't understand is that I'm naturally a saver. My parents are immigrants. Like we didn't come here with anything. Okay. So I'm not making fun of savers. I'm not literally calling them losers. I'm saying that their purchasing power is being eroded by putting it under the mattress or in the walls of their house or burying it in their backyard. Can you talk a little bit, just expand a little bit more on what you just said of trying to keep like the money circulating and not hoarding? That I think a lot of people don't really understand that.
I mean, yeah, there's nothing wrong with saving money for like emergency fund, things like that. But yeah, at a certain point, like you need to invest that money in something, whether that's like a stock or equity index fund, whether that's bonds, whether that's individual stocks, whether that's, real estate, physical real estate REITs. You have to get that money back into the system so that it can try and earn more money. Because if you don't, that just sitting there as money is just going to degrade over time. There's nothing that says something that's valuable today is going to be valuable 50, 100 years from now. And I think a lot of that's just like the world changes, technology moves forward. You can have imagine you bought something. I mean, imagine it's not a collectible. You buy let's say you bought a Model T, a car, right when it came out, whenever, 1920s, whenever the Model T first came out, you bought it and it's like a great car and everything. It's useful in its day and age. And you just put it away and you don't use it ever. It's a piece of technology. Well, time goes by and now you would never be caught riding around in that. That's probably worth money as a collectible, but let's ignore that.
Yeah, understand.
Its utility as a car is,
for the
its
sake
utility
of
as a car is kind of useless. Yeah, its utility as a car is useless. So you got punished because you didn't use an asset that you had, right? So that's kind of it's just something that happens. And it's like when you have advantages, you need to use them. If you don't use them, like you get punished for that. And that's like you could argue that's an evolutionary argument. You can think about like, if you have an advantage in an evolutionary sense, right? There's animals, whatever, and you don't use it, then it's like you're going to lose that thing if you're not using it because it costs energy to do that. Like, there's a cost with that associated with doing that. So yeah, in terms of savers or losers, I agree with that generally. Like as a, if you're just holding cash, holding physical cash, then yeah, you shouldn't be doing that. Obviously, how much cash you want to hold, that's completely up to people. I know people that have 25% of their net worth in cash. I don't necessarily think that's bad. But I wouldn't hold that much cash personally, but I think there are limits to it about what you do with it. Because you're right, it will inflate over time or be devalued.
Yeah, so. Absolutely. Yeah. I mean, so the premise was, and I know this was like just in a nutshell, but it's after you have your savings, like emergency fund. So typically my rule of thumb has been anywhere. It's kind of like the Dave Ramsey rule of thumb. It's 3 to 6 months, depending on where you're at in life. If you're just a single dude living in New York City, you don't need 12 months of emergency fund unless you're in, 100%, sales commission role or, own a business or something super high risk. If you have a family, maybe, 5-6 months, that kind of a thing. But yeah, this is with the premise of after you've already saved and have an emergency fund. Me personally, I keep about 15% of my net worth in cash. And I use that as offense and defense. So part of that is, the emergency fund. The other part of that is opportunity fund. So instead of just plowing that back into like, an S&P 500 fund or keeping it in the market, I want to keep it liquid because, say, for example, there's a real estate auction, in Cleveland, Cuyahoga County. You go to the courthouse steps, you buy property with cash. You need to be able to deploy that quickly, which you can do with stocks too. But, by the time you sell them and stuff like that, that time may pass you. So I think having cash is good for offense and defense. One of the last things I wanted to talk to you about was that you originally bought Bitcoin. I don't know what your cost basis was, but you did sell it at, I believe, 50 or 55K.
50. I sold it at 52 and I bought it at 8 roughly.
At 8, okay. So
I slowly acquired it over a couple months.
Yeah, can you just walk me and the audience through your thought process?
Yeah, so I was just buying. I'd gone back and forth on it so many times, and finally I said, I'm just going to buy it over time. And remember, so Bitcoin is not an income producing asset, so I keep it as a smaller percentage of my portfolio. I remember I did some analysis that showed like the optimal amount of Bitcoin to have if you had like you imagine all these asset classes do this like portfolio optimization. Was just a fancy way of saying have a computer figure out what's the highest returning portfolio per unit of risk. Like if I had to give you like the optimal portfolio over a particular time period, and from 2010 onward, it was like, I don't know, 53% stocks, 45% US bonds, and 2% Bitcoin. So I was like, okay, I should put 2% in Bitcoin. So I put like whatever it was at the time. I don't know if it was 2%. So I bought a Bitcoin basically, and I held it. And then it grew. Once it got to like 50K, it was much more than 2% of my portfolio. So I was like, hey, I have to rebalance. So I sold some of it down, sold half of it at the time, rebalanced into the rest of my portfolio. And I tweeted about it. I said, it was like, sold half my Bitcoin at 52K, ask me anything. And oh my gosh, it launched a firestorm. Some people said great trade. Because I didn't explain everything. I kind of left it open. People said, what did you buy? I got AK. Oh, why did you sell? Well, it was just a natural rebalance. I wasn't saying anything like Bitcoin's going to 0, it's going to 100. I was not making anything like that. But that's why I said, ask me anything, ask me questions. But it triggered so many people. And the joke is why I love it from a Twitter perspective. It's probably the greatest tweet I've ever done because I've gotten to reuse that tweet so many times. I'll quote tweet it. Like when the price of Bitcoin crashes a lot, when it's like down at 30, I'll quote tweet it with like, and they told us have fun staying poor. Those old rich guys laughing like meme. I like quote tweet that. And then when it goes up a ton, like it'll be above 50, it'll be like 60 or something. I'll quote tweet it with like the crying cat meme because I'm sad because I like sold too soon. Right. And I've done this like 6 or 7 times now. And now I don't know what Bitcoin's at as of this date. It's what, March 24th or something. So it's probably at like 40,000, 42,000, whatever it's at. There, yeah. So it jumps around all the time. And so like I just got lucky by selling it there. Obviously I didn't know that it was going to go up and down and all this stuff. So I'm like, I just had this thing where I did it and I was like, hey, I rebalance naturally. And at some point in the future, if it's low enough, and I am in a rebalancing moment, I'll buy more. I'll buy some of it back. It's just a question of when, and I'll figure that out. So yeah, I have nothing against Bitcoin. People think I'm like an anti-Bitcoiner. I'm not. I've actually changed my mind on it a bit. I think there is some value there. I just don't know what the price. I have no clue. I think there's some use case there. And we're seeing that right now with fiat currencies, everything's going on with like with Russia, Ukraine, everything. Like I think there is a definite use case for crypto and having that kind of a private bank that
Well,
only
I'm
you can access.
I'm glad that
Yeah.
I agree with that. I'm glad that you brought up the fact that you talked about how you rebalanced. So a lot of people, like when they invest, I feel like a lot of people, they don't even know why they're entering a trade. So like I get all these DMs every day, 100 plus DMs a day. Hey, Marco, what do you think about this? What should I do with this? I'm like, why are you even investing in the first place? So my wife and I, again, that net worth pie, we do that every month. Takes literally 5-10 minutes to just rebalance, see if we're in excess of cash or excess of precious metals or under in real estate, whatever those metrics may be, and you just rebalance. It's no different than rebalancing a pizza pie depending on your weight of your slices. And I feel like a lot of people, once they have these super winning trades, not only do they know when to take money off the table, they don't let their runners or their winners run, which is big. I get that. But at some point, you should at least take back your cost basis. And I did that with Bitcoin in last summer when it hit like 55, 56 grand per Bitcoin. I was buying same as you. I was buying since 2018, which was a little bit higher. But then I was buying heavy when it was like 4, 5, 6, 7, 8 grand. And then my cost basis was very, very low. But I still dollar cost average into Bitcoin every single week. But in the summer, I literally got rid of my cost basis and I was at zero. So I held a bunch of Bitcoin as profit, but I had no skin in the game. I had no money in it. Now it's dollar cost averaging. So obviously I still have money in it to this day, but it's very, very little. So I think this is one of those things that's going to become a staple in my portfolio. I used to believe that you should have some precious metals in your portfolio just as a wealth preservation tactic. It's not a good way to build wealth, but it's a good way to preserve wealth. What are your thoughts on precious metals in general? Do you think it's just a shiny gold rock because it's not an income producing asset? Like, what are your thoughts on that?
Well, yeah, so it's not an income producing asset. So I would keep it as like a smaller part of my portfolio. I mean, in the book, I say something like 85 to 90% should be income producing. Obviously, do what you want. It's your life. I'm not here to tell people what to do. But yeah, in terms of like, I put gold with like wine, with like, Bitcoin, art. There's a lot of things that don't necessarily produce income, but they can still be useful. I own, for example, some art and I own some cryptocurrencies, right? And so with gold, I've gone back and forth on gold. I think gold can be done as a trade. I think there's some evidence that like momentum stuff works with gold. But I think as a long-term holding, it's really tough because if you just look like, if you're really like, oh, I'm expecting this to go up over time, that's really a bad place to be because gold has had 20, I think it had a 20 or 30 year real like inflation adjusted drawdown from like 1980 to whenever 2000 something, I think it was 2012.
Yeah.
It was underwater. It's one of those things where remember, it's not an asset class with that much history. I mean, technically, like, oh, it's been around centuries. Well, it was money. So it wasn't really an asset class. It was really an investable asset class, but starting in 73, 74, or something like that.
Yeah.
So since then, it's been an investable asset class. And since then, like, it's been all over the place and it's really tough. Like I can't imagine holding an asset for 3 decades and seeing it be underwater for that long. Right.
Agreed.
I can probably abandon it. Like, and that's the thing to kind of keep in mind. It's like, you will probably abandon it after it has you're like, wow, it's been 15 years and it's still not above that price. You might abandon it. Now, of course, what you said, it's a wealth preservation. You want to keep it that's fine. You can definitely do that. But it's one of those things. I think the person to read on this is William Bernstein. I can't remember what he has an article on the internet. If you search up like William Bernstein, so Bernstein, William Bernstein. If you search him and search like gold or something, I can't remember the name of the article. It's called like the longest frontier or something. And he basically just talks about owning precious metals and how tough it is. And it's tough to own for a long period of time. So as long-term investment, it's very difficult. So, I mean, there's some evidence you can have in a portfolio and rebalance and there's stuff you can do, but it's tough. So that's
what are you mentioned income producing asset a few times now. What are your thoughts on, say, for example, just staking or lending out Bitcoin, for example, as collateral? There's some platforms like Celsius, for example, they'll give you 5.5% to just lend your Bitcoin.
Yeah. So I'm going to be honest. I don't know as much about that. I know a little bit about how it works. Like you give them your Bitcoin or whatever, your coin, and they give you some percentage. The issue is you lock it up, and if the coin starts dropping, like, oh, I got 5% on this thing, but like the value of it could drop, right? When you traditionally give money, like, I mean, of course that's true with when you're lending money with like cash as well, but it's very rare that your cash is going to drop 20% in a month, right? So ask all the people, everyone's like staking is great. In 2021, staking was the thing, but then ask all the people that have been staking from, December 2021 through February 2022, how it's going, because they staked all this money like, oh, look, I earned 10%. Yeah. But then your asset declined by 50%. So I mean, like, you see what I'm saying? It's one of those things where, like, yeah, you're earning income, but then the underlying declines so much that you've actually just lost less than you would have lost. So it's one of those things where it's really tough. So
yeah, understood.
And it's that's the risk. That's the risk you're dealing with.
For me, I would do something like a stable coin. I don't know how familiar you are with like USDC, for example, just a 1-to-1, one stable coin equal to $1, that kind of a thing. I don't know if I would ever lend my Bitcoin. To me, that's kind of like a finite, scarce, provably scarce asset for one of the first times in human history. So that's not something that I would be willing to give up for 5%. I can make 5%, in my sleep. So that's just not worth it for me. But a stable coin, I would consider doing something like that on. But it's almost been about an hour. I want to be respectful of your time. The questions that I usually ask at the end of the podcast are kind of like, vague. If you want to leave the audience with anyone or anything that you want to say, it could be about your book, it could be about investing, it could be about your favorite steak. I don't care. What would you leave the audience with a piece of wisdom or nugget of wisdom?
Yeah, I think the most important thing is just how you use your time with anything. This is true of anything in life, figuring yourself out and how you use your time. And so, if whatever you end up doing, just, figure out how you optimize your time. I think that's like the most important thing you can do. And that's true in investing. That's gonna be true in life. So people don't realize that a lot, but your time is very, very valuable. And, you only realize it later once you don't have as much left. And I think I've been very fortunate to think about that very early in life. And so, yeah, that's all I'd say. So just think about your time and what you're doing, what you're consuming, where you're spending your attention. You get 10,000, a little over 10,000 minutes a week. It's like 10,068 or something. You get 10,000 minutes a week. So every minute you can think of like a basis point, 0.01% of your week. So just think about where you're spending those minutes, what percentage of your life you're giving to certain activities and figure that out.
Yeah,
so
that's
my best.
That's very well said. I don't want to steal your thunder, but I have a video talking about the best investments you can make. Number 1 is health, 2 is time, 3 is, friends, family, relationships, things like that. I think a lot of people, they get so caught up in this, whether it's like a Western competitive, American lifestyle, or like a New York minute to use, where you're living at. I feel like they kind of miss the big picture of, hey, life is much more than just dollars and data, no pun intended. But but the dollars and data could be used as freedom units to get you to those other things. So it's always a balancing act, in my opinion.
Yeah, that's why, the tagline for my book is act smarter, live richer. And it's not just act financially richer, it's just richer in your whole life. And that's so, right. Yes, I'm obviously talking about finance. That's the lens through I talk about everything. But at the end of the day, a lot of stuff's about stuff in your life, things that you're going to impact you. So
awesome. Yeah. Where can people learn more about you, and where can they get Just Keep Buying?
More about me, you can either go to dollars-and-data.com, read some of my stuff, or Just Keep Buying. You find it on Amazon, the world's bookstore, basically. So just search Just Keep Buying. And yeah, I appreciate you having on the podcast, and hope you guys like the work. So
yeah, my pleasure, Nick. Thank you so much for coming on, buddy. I appreciate it.
Thank you for listening to the Whiteboard Finance Show. To read more about today's episode, visit whiteboardfinance.com. And don't forget to subscribe to Whiteboard Finance on YouTube. This show is for entertainment purposes only. Investing of any kind involves risk. While it is possible to minimize your risk, your investments are solely your responsibility. This show is copyrighted by Zlatic Media LLC. Written permissions must be granted before syndication or broadcasting.